Looks like we're going to get a lower open for U.S. equities today. That's after 3 days of gains on Wall Street. Let's get more from one of our favorites, Karl Schamotta, Chief Market Strategist at Corpay. Great to see you.
And you as well.
Ruling out this morning, your feeling is that investors have been more willing over the past few days to embrace risk?
Yes, unquestionably, we're seeing a bit of a more conciliatory tone from the Trump administration on the trade front. Fewer attacks on Chair Powell at the Federal Reserve. That's translating into a bit of a recovery in risk appetite, and we're seeing a bit of an impact on currency markets, where people are a little bit more willing to hold the dollar and aren't running for the exits at quite the pace that they were.
So you argue that global asset rebalancing flows have been losing steam. So
yes.
What rebalancing flows are you talking about here?
Yeah, so I think, over the last couple of weeks, this sort of big rise in the U.S. risk premium, the unpredictability of policy in the United States, et cetera.
Sorry to interrupt. What are we looking at there? What's that white line?
Good question. Oh, so that's one of my charts?
Yeah, sorry, I beg your pardon.
No, yeah, so that's the U.S. share of, it's various global markets' share of overall global market capitalization. And so what you're looking at there is the white line is the U.S. share of global market capitalization, which at one point was, well over that 50% level and has now retreated a bit, right? And so, what was happening there was investors were looking to park money outside the United States. Big institutional investors were keeping some of their money home, for example, in Europe, and Canada, Japan, et cetera, were all receiving some form of inflows, right? Now, the question is how long that's going to sustain, right? And clearly, we are seeing, in the very long run, a headwind emerging against the U.S. economy, in the sense that, it no longer looks like the only play in the global economy. It is a place with, sort of deteriorating rule of law, institutional instability, all of that, plus a lower growth trajectory than had been assumed, right? And outside the U.S., so for example, in Europe, we are seeing that, potential for a fiscal boost delivering more growth. And so that has meant that money has flowed out, right, out of the United States elsewhere. However, I do think that was all, somewhat exaggerated. We had that, really panicked reaction last week. The U.S. dollar fell. U.S. Treasury yields rose quite substantially in a very unusual dynamic. But now we're beginning to see sort of a more sober reassessment, right? And that sober reassessment is that, again, the U.S. remains the largest economy on the planet. The Treasury market is the deepest and most liquid on the planet. If you're looking for growth, it's still probably in the U.S. in the long run. And so this is a move around the margins as opposed to a secular, sort of abandonment of the U.S. exceptionalism story. Despite
the fickleness of current policy in Washington, investors are reckoning, no, it's not. We shouldn't abandon the U.S. wholesale.
Shouldn't abandon it wholesale, yeah. But, I think at the same time, we are, like a lot of the observers who are looking at this are correct in thinking that, this is a different world that we've sort of come out into. And that is that there are those alternatives. There is a good reason to avoid over-concentration in the U.S. And so what does that mean? It means that the bid behind U.S. assets that has persisted for the last couple of decades, right, most of our careers, really, that is no longer going to remain intact, right? At some point, we're going to see a more diversified allocation of global investment funds, a more diversified global growth picture. And in a weird way, this means that we have a more balanced global economy.
Prediction markets are calling for broadly speaking, 2025 recession in the U.S.?
Coin toss odds, yeah. So right now we're a little over 50% in terms of what the prediction markets are suggesting. It's interesting because, prediction markets, there we got a chart there. So you can see here that, we've seen a very, very rapid ramp in the number of people expecting a recession as Trump has sort of initiated this tariff war. It has moderated a little bit from the peak that we reached last week, but still, there's a significant contingent of people anticipating a recession in the U.S. And so, we take that and we overlay that on the Fed's expected trajectory, and that is pointing toward more easing, right? right now we have 3 rate cuts priced in. We had 2 Fed officials yesterday, Hammock and Waller, who are both saying, we are prepared to cut if the data starts to tell us that we need to cut. And so June is a live date for the next rate cut.
Yeah, but I think they stressed, or at least one of them stressed, the job market once we start seeing the job market.
Oh, without doubt. And that was kind of fascinating because it does tell us a lot about the Fed's reaction function. Powell last week was telling us, there are inflation risks that could come from tariffs.
Like, I don't know what we're going to do.
Which is very honest and very accurate. Let's be real. That's where we all are. We don't know how this is going to balance out. But what Waller was very specifically saying is that he sees price increases that come from tariffs as being a one-time shock to prices. He doesn't think that this, leads to a total unanchoring of inflation expectations. He doesn't think that the Fed should be setting policy on that basis. What he does think the Fed should be reacting to is softness in the real economy. And I would be inclined to take the same view, right, is that even if we are seeing prices increase in the U.S., the effect on growth is far more meaningful, right? The idea that we might be seeing an increase in joblessness, that businesses are going to cut back investment, that's ultimately going to lead to weaker consumption. All of that means that the Fed should be moving toward neutral at a faster pace than it was.
I suppose you could say, to Trump's credit, he has said, there's a possibility of economic pain here.
Yeah, he said that after he was elected. So, but the funny part was, ahead of, gaining office, it was very much that the U.S. economy is going to do fantastic. And just in the last couple of weeks, as we've seen the softening, he has, acknowledged that there's a weakness in the economy, that we could see a recession. And he has sought to pin blame on this on Jerome Powell. So, I give him some credit in the sense that this whole process might actually rebalance the global economy in a favorable manner. But the reality here is that this is a policy-induced slowdown in the U.S. Very, very unusual historically that, a government deliberately pushes an economy into recession, and that certainly seems to be what's playing out here, possibly. And again, we're all sort of flying blind here. It's very possible that all the tariffs are lifted and that investor confidence comes back, consumers remain sort of unaware or unconcerned about all of this, and the U.S. economy skates away from the edge that it's at right now.
Very quickly, I'm sorry, we never have enough time with you, Karl. The poly market is calling for a Liberal victory on Monday?
Yes, overwhelmingly, 80% odds and higher on a Carney victory. And so, what this means, I think, really fundamentally is that if Carney does win on Monday, if we do see a Liberal majority, that currency markets aren't likely to react all that dramatically, right? And even if we do see, a surprise Conservative victory, I still don't think currency markets pay that much attention. It's at this point, the Canadian dollar is very much dancing to a tune played in the U.S.
Karl, always great hearing from you. Karl Schamotta is the Chief Market Strategist at Corpay.